Good morning or good afternoon, everyone. We're delighted to have you here. I'm Janet Cox from 350 Silicon Valley, and we've been working with a bunch of wonderful partners to sponsor a series of events during Climate Week. We're calling them Global Conversations on Finance, Risk, and Investing in a Low Carbon Future. You should have a link to the whole series in your Eventbrite response. So we just did a little bit of background. We have two more events scheduled after this one. There's one tomorrow on coal policy and financial risk, and another one later on tomorrow on legislative strategies for decarbonizing the future. You can use the link to find these and sign up, and we hope you'll join us. We will also post the links to all of the sessions in this series on the 350 Silicon Valley website, and we'll send everybody information about that later. Just a couple of housekeeping items before I introduce today's panelists. Please introduce yourselves in the chat and note your affiliation if you're part of a group or a business or a law firm or whatever. And please use the Q&A button at the bottom to post questions, and we'll get to them after the presentations. So today's event is really seminal to the entire topic. When we were putting this together, I was trying to figure out how we could append this information on the front of all of the rest of these events, because this is really the information that campaigners and decision makers and fiduciaries and legislators need in order to evaluate risk as they are making investment decisions. We're just really lucky to have these two panelists. Kathy Hipple is a financial analyst at the Institute for Energy Economics and Financial Analysis, which we know as IEFA, and she is a finance professor at Bard's MBA in Sustainability. She writes extensively on responsible investment and divestment. She's been a vice president at Merrill Lynch, where she spent 10 years placing fixed income securities with international institutional clients. She founded and was CEO of Ambassador Media, a New York-based company with revenues of more than $35 million, and she has an MBA in sustainability. Lucas Ross is a program manager at Friends of the Earth, where he focuses on federal budget and ending subsidies for polluting industries. Previously, he was a research fellow at the Oakland Institute, which is a think tank specializing in land investment and sustainable agriculture. He worked there on biofuel policy and financial sector investment in US farmland. So we're just really fortunate to have these two people who are good thinkers and great communicators putting this information out in front of all of us, because this is what we need to know. So with that, I'm going to turn it over to Kathy, and thanks again for joining us.
Thank you for the introduction, Janet. It's a delight to be with you. I think, Vanessa, you need to stop sharing so I can share. Okay, so I'd like to share my screen, if I may. I'm hearing some background. How is this? Everyone can see my screen, I'm hoping. Yes, great. Okay, so again, thank you. It's a delight to be here. This is extraordinarily important work during Climate Week. And I look forward to the challenge that we're all working to solve. Today, as Janet mentioned, I'm going to be speaking about the future of big oil. And no surprise, they've had weak long-term financials, and COVID has only accelerated them. So first of all, for those of you who don't know IEFA, it's an international think tank, And we produce work about the energy transition with the goal of creating a diverse energy mix around the world, leading to, and what I do is research from a financial standpoint this energy transition, especially as it relates to oil and gas. IEFA has produced more than 200 in-depth reports, including coal initially throughout the United States. We've then moved into gas and oil extensively. We started producing a tremendous amount of work in Asia and Australia, again, initially focused on coal, but rapidly moving into oil and gas. And in the last few years, we've really been covering Canada extensively, Europe, South Africa, and quite a bit in Argentina. There's a shale basin down there called Vaca Muerta. So again, we've been doing a deep dive into the financials of oil and gas companies. And the overview I'm going to talk to you about is that these companies are vulnerable and they are in long-term decline. They are not dead, but they are in decline. They have underperformed the market for a decade. And financially, the oil and gas sector has been a bust while they have had a production boom. So this is very confusing for people. They're producing so much oil, they're producing so much gas. How can it be a financial bust? The energy sector, or I should say the fossil energy sector, is shrinking. And today, oil and gas companies, big and small, are in extremis. Okay, so let's just go back to March. For those of you who have been living under a rock, you'll recall that in March, the whole world changed. It affected the oil industry because demand for oil and gas plummeted. And then Russia and Saudi Arabia began an oil price war. So the world was radically different. There's almost the before COVID and the after COVID. Now, the industry would like you to believe that this was a black swan event, that no one could have foreseen the pandemic and the demand crushing scenario that would befall that industry. But that is not true. The decline began a long time ago. So how long and why is what we're going to talk about. So approximately 10 years ago, the so-called fracking revolution began. And it's two different factors. One is hydraulic fracturing, something we call fracking, which is injecting very hard rocks with a mixture of sand and water and chemicals to produce the oil and gas that had previously been trapped. The other part is that these wells are very long. So it's a combination of these very long, like over miles long, horizontal wells and the fracking that created this boom. And it's been mostly US centric. It has in fact sent the US gas production to all-time highs, making the United States the largest producer of gas, fossil gas in the world. And it propelled the United States also to become the world's top oil producer. So you can really see this began around 10 years ago. Yet, again, confoundingly, the US oil and gas sector has performed terribly in the stock market. So you've got a nice little graph here about how the S&P has been moving higher while the oil and gas, the ETF, exchange traded fund, has really plummeted over the last several years. So here, if you look at smaller companies, is something that we've been following. Another colleague of mine, Clark Williams-Derry at IEFA, and I have been, and Tom Sanzilla, we've all been looking at the smaller companies that only do fracking. It's called exploration and production. And they frack for oil, mostly in the Permian Basin and a few other basins. And then they frack for gas, primarily in Appalachia. Now, you also know that in the Permian, the big money is supposedly in oil, but also gas comes out. So, but the bottom line is financially, these companies have never been able to be cash flow positive in aggregate for the whole fracking revolution. Each year they have burned through more cash than they have earned selling oil and gas. So this, not surprisingly, has led to a rash of bankruptcies. So those are the smaller companies, and the smaller companies and the big oil companies make up the energy sector in the S&P 500. And when they say energy, they have only fossil energy in that. It does not include renewable energy. And you can see that over the last 10 years, the whole market has been up about 190%. The energy sector has been up only 6%. Not surprisingly, IT has led the market, is up over 300%. So clearly energy has been a terrible sector, the worst sector. Throughout 2020, through the first half of the year, it continued to be the worst sector in the market. So this leads to a case of, if it's the worst sector over a decade, the worst in 2018, the worst in 2019, the worst in the first half of 2020 so far. So along with this terrible stock market performance, what we're seeing is this energy sector is shrinking. And as recently as, or as a long time ago as December 1980, the energy sector made nearly 29%, it comprised nearly 29% of the S&P 500. And in June, it was down to 2.3%. My graph's a little bit old. It was done in March. It was 2.6%. So what you see is the energy sector has become much smaller, 90% smaller, relatively speaking, as a percentage of the whole market. So that's one way of looking at it. Another way of looking at it is in 1980, 7 of the top 10 companies were oil and gas companies. And GE, which announced yesterday it was exiting new coal builds, could have really been considered a fossil fuel related company. So you can see that by 2018, there was only one left. It was ExxonMobil. And there was a big day in September 2019 that ExxonMobil fell out of the top 10. And you can see it's a very different picture of what we see now. Another way to look at it is big oil is shrinking, because I know the focus today is on big oil, not just the small E&P companies, the fracking companies, but these big oil companies largely have gotten into fracking. Exxon, Chevron, Shell, and BP have made big moves into fracking in the United States. Alongside that, they have also been getting smaller. So this is their market capitalization or their market value. And you can see as recently as 2018, it was 1.2 trillion, and now it is down to half of that. Okay, so these companies individually and collectively are shrinking. They're getting smaller. And in some cases, Exxon was twice as big as Chevron several years ago, and now it's only a slightly bigger than Chevron. But you can see the trend is this is a shrinking industry. These companies individually and collectively are shrinking. So another way of looking at this is the companies are still paying for the most part, except for BP and Shell, which really did reduce their dividend. Over the past several years, they've been paying high dividends. However, that has not been enough to keep their stock price up. Their stock price has performed terribly relative to the rest of the market. So you see the dark blue line, and that's the S&P 500. And then you see all of the 5 oil majors, the biggest private oil companies in the world before Saudi Aramco went private, but that is still largely state-owned. So there's something interesting when we started to really analyze these companies. We looked at their cash flow, because cash flow really tells a story. It says how much money are these companies bringing in from selling oil and gas and petrochemicals versus how much are they paying out. And what we discovered is that these companies for the 10 years between 2010 and 2019 were paying out more to their shareholders in the form of dividends and share buybacks than they were earning selling oil and gas and petrochemicals. So they've had to make up the shortfall over this time by either issuing more debt or selling assets. Some would say this is an unsustainable long-term practice, and it affected all of the companies. Exxon was the worst. Its so-called deficit was the highest of these companies. I'm used, air quoting deficits, but its payout to its shareholders was far more than it brought in with its primary business over this period of time. A different way of seeing it here. So again, ExxonMobil, through the first half of 2020, continued this trend of being very generous with shareholders, but not bringing in enough from its core business to cover that. So again, they issued a tremendous amount of debt in the first half of 2020. So the big oil companies are facing major challenges. They've experienced massive write-offs. We expect more to come. Demand forecasts for their primary products, which are oil, gas, and even petrochemicals, have been slashed. There is an oil and gas glut, a global glut that will probably not ease based on forecasts for at least a year or two. And petrochemicals will not be enough to rescue these companies. We've called this the last frontier. It will not save this industry. So just getting to impairments for a second, British Petroleum in the second quarter, BP, it's now called, took a write-off. And these are jaw-dropping numbers, because sometimes you talk about these companies and they have market caps of 150 billion, and it's really hard to get your mind around some of these numbers. But when you start having companies writing off 17 billion, 8 billion, 12 billion, 5 billion, Exxon, which hasn't written off as much as the other, did say that they may have to write off up to 20% of all of their assets when they look very carefully. And they said if oil prices do not go up, they put this in a filing to the SEC, that they may have to write up to 20% of their whole company's reserves. Now that is just a massive write-off. So we expect that the oversupply or the glut will continue, that demand forecasts will continue to be cut, impairments will continue to be announced, and capital expenditures will continue to be cut. What we've seen is that debt and equity investors have been fleeing the sector. We expect that to continue. So here's global gas demand. The IEA said this was the largest recorded demand shock in the history of global natural gas markets. The oil market remains fragile. There are enormous uncertainties. They're talking about 8 to 10% down just in 2020. And what happens is every time IEA or EIA comes out with another forecast, they ratchet the demand scenario down further. So what have the companies done? They have really slashed their capital expenditure budgets. And these are the investments they're making for the long term. These budgets are in the billions, the tens of billions in some cases, and they basically are expected to last for decades. And some of the companies have cut them by 20 or 30%. Collectively, the industry has cut this by about 30+%. So we could expect that the oversupply of oil and gas will continue to put downward pressure on the sector. And what does this mean for stock prices, which is probably something that people continue to look at? And my favorite quote, and this was a Redburn analysis, and it was a very cleverly titled report. I only wish I had come up with it myself. It was called Oil Majors Lost in Transition. And it said, when industries face existential risk, historical multiples provide no floor for share prices. So that's a fancy way of saying that normally a company would trade at a multiple of its earnings or a multiple of its revenues. And that's kind of Wall Street speak, but we can all understand no floor for share prices. That means there is no logical bottom for the equity prices of these oil companies because they face existential risk. So I will turn it over at this point. And again, thank you for the opportunity. Oh, I'm sorry, can I just have 2 more minutes? I realized I wanted just to talk a little about how the oil and gas companies are not moving in the same direction anymore. So how are they responding to this crisis? So oil majors were once in lockstep. So if you knew what Exxon was doing, and we did a lot of work at IEFA on Exxon, the leader, and you more or less knew what the other big oil majors were doing. They were traveling the globe, operating in every continent, in many countries, exploring for endlessly new supplies of oil and gas. That is no longer the case. Now the strategies are diverging. So to know one oil company is not to know all of them anymore. You really do need to look at others. However, some of the companies, ExxonMobil and Chevron in particular, are doubling down. So Exxon said, despite the challenging environment, the corporation's view of long-term supply and demand fundamentals has not changed significantly. They said this at the end of Q2. This is at the end of June when they spoke about this in July. So while the whole world is saying the world changed, Exxon said, actually, no, nothing's changed. Chevron said something very similar. I won't even waste your time with the quote. However, the European oil majors are beginning to take some small steps. And we have tremendous hot button debates within IEFA. Are they doing enough? Is this significant? Is this just baby steps? Is this a tremendous pivot? And it's unsettled, it's bumpy. We're living through a transition. But Shell did make a promise to become carbon neutral by 2050. They're going through massive restructuring. They're talking about cutting up to 40% of operating costs and capital spending in their upstream. That's their exploration and production. They're expected to see deep cuts in their gas division, and they're talking about massive layoffs. So that's Shell. Moving forward, maybe not fast enough, maybe not aggressively enough, but they are making some forward progress. And then one company I think did some pretty significant, which was British Petroleum. And it's the most significant pivot as yet among majors because they're cutting their target production. So it's the first of the big 5 to say, we're going to start producing less oil and gas than we have in the past. So not only are we putting a target of 2050 net zero, they're actually saying we are going to pull less oil and gas out of the earth than we have been. They announced last week that they're buying into a big offshore wind product, buying some percentage of it from Equinor, and they do plan to put an annual budget of $5 billion a year by 2030 into low carbon investments. Now, at IEFA, we believe that it should be 50% of their CapEx budget, certainly more than this, but this is a step. And I think it's important to acknowledge the step. Is it enough? Investors can decide that. So thank you very much, Janet and Vanessa, for organizing this. And I am happy to turn this over to Lucas.
Okay, I think I'm unmuted and I'm going to try to share my screen now. Bear with me. Janet, thumbs up if this is coming through. Excellent, excellent. What I think Kathy has just done is paint a very compelling portrait of an industry in economic decline. What I would like to do now is spend some time trying to weigh the political dimension. What is the policy response to COVID-19, and how has the oil and gas industry benefited or not benefited from it? it's sort of hard to overlook that over the last 6 months, we've seen some of the largest state interventions in our economy, in our economy's entire history. So could oil, which still holds massive political power, leverage this moment of massive state intervention to arrest or reverse some of these trends towards economic decline, some of the factors that Kathy was talking about? Are we witnessing, or could we be witnessing, a big oil bailout? And that term, big oil bailout, has been in the sort of popular conversation, I would say, since March, about a week before lockdown started, when it was reported that the Trump administration was floating direct aid for the domestic shale industry. And whether we like it or not, and I don't always like it, it's part of the dialogue now, and it's part of how the media, advocates, and members of Congress are trying to make sense of the sort of different pieces of the COVID-19 response and what their implications are for the fossil fuel industry. And, you know, like I said, I gotta say, this isn't always a very helpful way of thinking about the oil and gas industry, period. I think sort of crucially, it isn't as though there was this status quo of government non-interference in the oil and gas industry that was suddenly suspended in March. A switch was not flicked because of the lockdown that sort of turned on federal government potentially intervening on behalf of this industry. The history of big oil, as we know, is very much a history of subsidization and a history of state support. That's true whether we're talking very broadly about, I don't know, aircraft carriers in the Persian Gulf. That's true whether we're talking about research innovations sponsored by the Department of Energy that made the fracking boom possible. And that's especially true regarding the tax incentives upon which the industry still relies, and without which large percentages of future extraction would become uneconomical. These incentives are, you know, practically as old as the industry itself, and, you know, date not very long after the original dismantling of the Standard Oil monopoly. So it's not an exaggeration to say that from its very inception, the oil and gas industry as we know it, did not actually, the oil and gas industry as we know it has existed alongside state support for its entire existence. I think, you know, broadly what we're talking about here is not a bailout that debatably began in March, if indeed a bailout is underway, but sort of a series of interventions that really need to be contextualized as part of a 100-year history of state support. And I think that most notably here are the tax incentives. For example, the deduction for percentage depletion and the deduction for intangible drilling costs, which date from 1926 and 1916 respectively. For a quick piece of context, these are tax subsidies that have been modified over the years, but which are, you know, very long-standing. And what they essentially allow the oil and gas industry to do is deduct the cost of extraction more quickly, increasing their cash flow and allowing that money to be pumped back underground in effect and spent on more extraction. It's a little bit like a treadmill. So as we turn to how the industry is benefiting from COVID-19, the question is really not whether they are benefiting, but how much, and how disproportionate are their benefits relative to the rest of the economy and relative to what's actually required for this moment of crisis. And I think that just to sort of set the stage here, there are a lot of different pieces that have been sort of talked about as part of this broad idea of a big oil bailout, different policy levers, and some of them are very persuasive, and some of them it actually makes sense for us to be very skeptical about. Ironically, one of the issues that has attracted the most attention is one of the least consequential. Early in the crisis, the Trump administration proposed to increase the price of oil by making bulk purchases into something called the Strategic Petroleum Reserve. This is basically the nation's emergency oil supply. Originally, Trump requested $3 billion to fill up the emergency oil supply as part of the original COVID stimulus bill back in March. And he actually didn't get it. It was removed from the underlying bill as part of negotiations. And I think crucially, later on, Secretary of Energy Dan Brouillet, having not gotten money to go out and buy oil, started renting out storage space in the Gulf of Mexico that is federally owned to companies. I think that, it's an important point here that even if $3 billion had come through, compared to the sort of force of gravity that's the force of gravity that are the economic trends that Kathy was talking about, it's very difficult to make a persuasive case that $3 billion was going to be a major thing. So this didn't happen, and even if it had, it's sort of hard to imagine that this was, the major lever that would have, been a substantial source of aid to the industry back in March. I think also crucially, if we're assuming that the burden has fallen most heavily on those smaller exploration and production companies that Kathy was talking about, it would have been hard logistically to get the Strategic Petroleum Reserve to really come in on their behalf. And that's because this isn't just, a pot of oil all sitting in one place. Because it's our emergency supply, it actually needs to stock a lot of different kinds of oil to suit different refining needs. So it isn't as though we could have just gone to the Permian Basin, gone to North Dakota, gone to these other places that are predominantly producing sort of light, sweet crude oil and just said, hey, we'll take it off your hands. It wouldn't have logistically worked like that because of the legal requirements associated with the facility itself. This is probably way more about the Strategic Petroleum Reserve than anyone wanted to learn, but if I had to read up on this stuff in March, well, I might as well use it. So besides that, another one that I actually find a little bit more persuasive is royalty relief. This one is pretty straightforward. Basically, any mineral lease on public land or water pays royalties on the proceeds from sales, usually to some combination of the state and federal government, and usually somewhere between about 12.5% or 16%. But the Secretary of the Interior, who right now is a former oil lobbyist, has the power to grant royalty relief in exceptional circumstances on a discretionary basis. And since COVID, that's exactly what he's been doing. As of this month, at least 521 cases of royalty relief have been implemented, dropping the rate on some of these public leases to as low as 0.5 percentage point. So that seems like it's a substantial benefit to the industry, and here absolutely the benefits are a little clearer, but again, it is sort of difficult to find a there when you're looking at royalty relief. Most drilling isn't happening on public lands, remember? And if the problem here is really an overall glutting of the marketplace, how beneficial is it really to pay lower royalty rates on oil that isn't really turning a profit? I think also substantially, most of the cases of royalty relief that we've seen so far, over 80%, are concentrated in Wyoming and Utah. You simply aren't going to get, you're not going to convince me, and you're probably not going to convince anyone else that these states, which barely crack the top 10 in terms of oil production, are ground zero for some kind of unprecedented rescue mission. If you want the real evidence of where help is being offered to the oil industry, where the actual money is, where there's actually a risk to the climate and a risk to prolonging the lives of some of these companies, you have to look deeper. And where you actually find what I think is the sort of beating heart of the matter, what could, under a lot of circumstances, be called a bailout, you have to look at tax policy, and you have to look at the emergency programs that are being managed through the Federal Reserve and the Treasury Department. So let's start with the CARES Act. That's the Coronavirus Aid, Relief, and Economic Security Act. This was the $2.2 trillion piece of emergency legislation passed in March. This was the last real piece of aid legislation to get through Congress. And it's mainly associated with those $1,200 checks, if you were lucky enough to get one, and with the expanded and now unfortunately expired expansion of unemployment insurance. What it really wasn't known for was $300 billion in corporate tax cuts, which largely flew below the radar. I was actually watching the bill very closely, and I'm pretty ashamed to say that at the time I missed them too. So after the fact, after the CARES Act became law, we got down to looking at the quarterly lobby filings. And what we saw was that the oil and gas industry lobbied more heavily on the tax provisions of the CARES Act than they did on any other section. It was their biggest single point of intervention in this massive bill that's arguably the biggest single piece of legislation, maybe ever, to pass the US Congress. And it makes sense that they intervene there substantially because the evidence is very significant that they benefited disproportionately. But to understand exactly what the industry got here, give me a second to be a tax nerd here. It's good to rewind to 2017, excuse me, when the Trump administration forced through these massive corporate tax cuts. The oil and gas industry entered that particular tax reform process with two main goals. It wanted a huge tax cut, who doesn't? And it wanted to protect all the special interest deductions that have kept their tax rate artificially low for their entire history. Now, those are the special interest loopholes that I was talking about before, but there were two other areas that they flagged at the time as specific areas of concern. One is that they wanted to protect the ability to deduct interest from income taxes. Another is that they wanted to be able to deduct net operating losses, or NOLs, which is when a business incurs a loss, basically. They wanted to be able to deduct those losses incurred in a current year against income taxes paid in previous years. It's really exciting stuff, I know, but please bear with me. Now, the oil and gas industry got to protect its special interest subsidies, but on those two questions, it actually didn't get everything it wanted. In order to pay for this overall cut to the corporate rate, the amount of interest that could be deducted was capped, and the ability to carry back losses to previous years was removed as well. It could only be carried forward now. I think that, if you're going to hide a bailout, I would say that tax policy is probably the best place to do it because this is so goddamn confusing. But the main thing to keep in mind is that fast forwarding to the CARES Act, one of the things that those $300 billion worth of corporate tax rates did was essentially go back and temporarily erase the only two things about the big Trump tax cuts that the oil and gas industry disliked. The cap on interest was raised, and losses from 2018, 2019, and 2020 could be deducted back against income taxes paid over the previous 5 years. Like I said, this gets pretty arcane, but in English, what this basically means is that if you are a heavily indebted company and you are a company facing substantial business losses, this means the IRS is probably going to be sending you a check in the mail. And already we have seen that the oil and gas industry has benefited from this disproportionately. The refiner Marathon is getting a refund worth $1.1 billion. They're the biggest one out there right now. Whereas a number of companies that Kathy follows closely and that are in the IEFA shale data set have all recorded benefits over $100 million. So really what we have here is a major lobbying intervention from oil, and the result is a change in tax policy tucked into emergency legislation that benefits oil disproportionately. What it means is more tax incentives for an industry that has historically thrived as a result of tax policy. It's cash on hand when their ability to get cash from selling commodities is compromised. So the other dimension I want to consider here is the Federal Reserve, which has emerged during the COVID crisis in some really unprecedented ways. In March, to calm financial markets, the Fed announced a raft of emergency measures. This included a new and totally unprecedented plan to begin purchasing private corporate debt from the bond markets. This was a first, and the purchases wouldn't just include the relatively safe debt of investment grade companies. In certain cases, it would be purchasing the riskier debt of high yield or junk rated companies. And administering this program would be BlackRock, which I know many people on this call are interested in separately, the largest asset manager in the world, and as it happens, the largest owner of fossil net. The Fed would also have its finger on the trigger for potentially $4.5 trillion worth of lending programs that could be doled out to companies and to municipalities. And supporting the Fed in all of this was about $450 billion in funds from the CARES Act. This money would be used to support the Fed and to cover any of its losses making these loans. The result of this was a massive rally in stock prices. If you want to look for an explanation at the recent record rally in stock prices, the Fed's intervention was the single biggest factor. And unsurprisingly, as the Fed has moved to backstop the corporate bond market, a massive borrowing binge has ensued. The total, according to Fitch, was $500 billion in new debt from non-financial companies just between March and May, and that is a record. So the question here becomes, is this intervention like the tax cuts? Is there evidence that oil and gas has benefited disproportionately from an action designed to support the economy in general? This is where I have to start to get a little vague. I apologize because in just a few days, Friends of the Earth has a report coming out with Public Citizen and Bailout Watch that answers this question very much in the affirmative. So please read the report when it comes out. And in the meantime, please enjoy this preview. And I see Dan Wagner in the chat here. He probably could do this better than I can, but you're stuck with me, unfortunately. The top line here is that since the Fed began its rescue mission of corporate debt markets, nearly $100 billion in new bonds have been issued onto US markets from oil and gas companies. That is a record for the year to date, for the decade, and it is well on its way to being a record period. But the benefits aren't being experienced evenly. And this goes to something that Kathy was saying about Exxon, which I actually think is one of the starkest examples. In March, actually, just before the week before the Fed announcement, Exxon sold about $2 billion worth of 10-year bonds at a coupon rate or an interest rate of 3.42. This is just a standard fixed income product. But a month later, as part of a massive $9.5 billion debt offering, Exxon sold another $2 billion in 10-year notes. But this time the interest rate was almost 1% lower. That's a pretty substantial drop for a multi-billion-dollar loan, and it translates into savings worth tens of millions of dollars. The savings are probably higher when you consider the fact that Exxon is using this money to refinance other debts. So it's really just stacking the benefits for them. So that's what the bigger, comparatively healthier companies are doing. What about the frackers? It turns out that many of them are going to the bond market as well, but at a far steeper cost. Range Resources, SM Energy, and EQT, companies I know Kathy follows very closely, all of them have issued new bonds in the last 6 months, but they have done so in order to buy back imminently maturing debt. And to get out from under that looming debt, they're paying far higher interest rates. So I think, just to tie this up, like already there has been around 50 billion in oil debt associated with bankruptcies in 2020 alone. So you could argue, I think, very reasonably that if this is a bailout, Trump and his cronies are doing a terrible job. But at the same time, I think that the picture is more complicated. If we're taking Kathy's view here, which is that one way or the other, the oil and gas industry as it's configured today is on a road that's headed for a cliff. What is the Federal Reserve doing here? What is this unprecedented bailout of corporate debt markets doing? It's building a little bit more road for them. It's a little bit nicer on the bigger, ostensibly more stable companies, but a lot of other companies are getting a little bit more time before they hit that cliff. So I think that, the real thing to take away here is that whether or not the road runs out, you have a lot of companies that are going to get maybe a little bit more time as a result of this. And, I think that this is the point that it's worth dwelling on here. They are getting this help at a time when the rest of us are getting pretty close to absolutely nothing. There are no more $1,200 checks in the mail. The expanded unemployment insurance has expired. And we can't even force the utilities to keep the lights on for folks, in most cases, when they can't pay their bills anymore. So just to conclude very quickly, this is just a sort of eye on the future here. What's going to happen next is, in theory, these emergency programs are slated to expire in December with the Federal Reserve. Will they continue? I think to a large extent that depends on what happens in November. Will there be a new announced Treasury Secretary by then? Will they want to keep these emergency measures going? And will that be a window of opportunity for us to try to modify how the Fed is implementing these programs to maybe take the thumb off the scale for fossil fuels? And will there be another coronavirus aid package because the negotiations for the last one fell through? Will there be potential benefits for oil and gas in there? Just at the very least, there is a new subsidy for enhanced oil recovery that the American Petroleum Institute and many others have been loudly advocating for because they think enhanced oil recovery is a climate solution. Don't get me started. But there is, with the give and take of a major relief bill like that, there's a lot of money that could go out the door, and a lot of it could be sector-specific aid for energy. The renewable energy industry has its eye on, the renewal of its tax credits, which have by and large expired or are expiring. Does that mean to balance the scales, Republicans are going to get a favor for oil in there? Depends on what happens in November. And with that, I don't think I ran too far over. We've got time for questions.
Thank you so much. That was really fabulous. And, we have a recording of this that we'll send out to all of you, and we hope that you will share it widely with all of the folks who need to know this information. This is just golden. So we have a lot of good questions. There are a couple of quick ones I'm going to run through quickly. One attendee is asking, Lucas, do you have a paper or a summary of how the CARES Act benefits the fossil fuel industry? There's something that sort of pulls this all together in writing.
Yeah, if you give me your email, I can send you that. I think that
you send it to me, and we'll send it to the attendees.
Cool.
That'll be good. So this is a related question to your last comment. Randy Mail in Massachusetts asked, how can we undo the bailout to fossil fuels? Is there a precedent to reverse these giveaways, like having the banks pay and the auto industry pay back their government loans after 2008?
I guess, do we want to take a couple, or should I just take them as they pop up?
Why don't you take them as they pop up, and we'll just rip through these. Cool.
Yeah, I think that there's a whole set of demands, and I can send this to Janet as part of the follow-up. But a lot of this stuff is being executed through the black box of the Federal Reserve, which is using BlackRock as its contractor. I think, like, broadly, the demand is that the mechanism here is the purchase of corporate debt. There is about $300 million worth of debt that the Federal Reserve has purchased from the fossil fuel industry since the intervention began. If we wanted to modify the ability of these oil and gas companies to theoretically access the bond market, the demand would be to start screening purchases through the Federal Reserve so that they could stop using this as a means to backstop fossil fuel borrowing. The Federal Reserve has a broad mandate to protect employment and price stability, but it usually likes to pretend that climate policy is not in its bailiwick. I think we need to be very clear, and probably to start treating the Fed like a political target a little bit more, and to get it to stop buying debt. I think that is that would be the way to that's the pressure point that we have before us now, is to get a guarantee that the Fed will get the current oil and gas debt on its balance sheet off of its balance sheet, and to get them to stop buying new debt with their emergency powers.
Who else is buying that debt? Do you have a sense?
Well,
go ahead, Kathy.
And for those who don't have a long background, it's an extraordinary move for the Fed to buy corporate debt. Until this financial crisis, it had never done that in its history. And it's especially extraordinary that it bought so much below investment grade. So back in the day when I was on Wall Street, we called those junk bonds. Now they're called high yield bonds. So if a bank for example, said, we're going to give a loan to a below investment grade credit, most credit committees would say, no, 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 no. So this was an extraordinary move. And the word unprecedented has been used too much. But I don't know if we want to say the Fed should never buy debt, but it should acknowledge this is a very unusual move. Maybe the times demanded it, but it should be transparent about why it was necessary to buy below investment grade debt. And we know that most of the fracking focused companies have below investment grade or high yield debt. I mean, they are like, you would not invest in them if you were a very prudent investor because their ability to pay back the money has been very compromised.
And who else? I would imagine that the Fed buying this debt sort of sends a signal to other investors that this is an okay thing to do. You think that's right? Who else? CalPERS just had a bill that they pulled, thankfully, that was going to allow them to shield the private debt that they buy from any kind of public scrutiny. But do you have a sense of who else is buying the debt, for instance, from Exxon, which has a lot of it to sell?
Well, Exxon, remember, is still high credit rating. It's AA, down from AAA. So every bond fund in the world, unless it has a divestment clause, like we will not lend to fossil fuel companies, likely has exposure to the high, remember, Exxon and Chevron and most of the super major oil companies have investment grade debt. So that means PIMCO, every one of the biggest bond funds in the world, certainly BlackRock is one of them, but Vanguard, State Street, all of the usual names. PIMCO is the largest bond fund in the world. They certainly have a lot of that debt.
Yeah, it's something that I've been meaning to look into just sort of as a follow-up to the report because, when we say Exxon issued 9.5 billion in new debt in April, I mean, like, it's still an investment grade company, but, all of the new bonds that have been issued, I mean, by and large, like, a large part of this debt was probably snapped up and rolled into investment products that are sold over the counter to, people like us. So at a certain point, that stuff is going to end up in an ETF or a fund that, is just something that, maybe we see once a year as a statement, but the toxic debt is, like eventually toxic, I should say. But like there is a question that like, if eventually we're headed over that cliff, where this debt is sold, I mean, in a lot of cases, it was sold to us in the broadest term because of who actually ends up buying these investment products to, secure some, scrap of security in retirement.
Thanks. Here's a slightly different question. What are the implications of the climate nuisance lawsuits against fossil fuel companies on the energy market and the industry as a whole? Do you see anything happening in the short-term sense of risk?
Well, they're mounting. One of the things we talk about at IEFA is that it's not just one risk facing these companies, it's many risks. It's the financial risk, and then it's the liabilities from all these so-called public nuisance lawsuits. There are whistleblower complaints that, for example, Exxon has not written off enough of its $30+ billion acquisition of XTO, that they're at risk of securities fraud. So there are so many of these lawsuits coming at these companies, and companies like Exxon and Chevron have had a practice of fighting them very aggressively, but there are a lot of them now. And the people who are suing have become more and more sophisticated, and I think it's a material risk factor for each and every one of these companies. And if you look at the material risk factors that they list, they do list these kinds of litigation as potential risk to their businesses.
Do you see a current or future shift toward fossil fuel-based plastics production to offset declines in the other markets such as gasoline? And is this, well, just, that's the question. I mean, I think we know what's happening, but maybe you can elaborate a little bit, Kathy.
So I think when you look at an integrated oil company, the logic is that they can make money somewhere. If they don't make it with their exploration and production, producing oil and gas, if prices go down, then that's good for their plastic business, or that's good for their refinery business. And what we're finding is that that's not actually the case. So some of the companies say, well, we'll do less exploration and production and more petrochemicals, because as the world economy grows and the middle class in China and India grows, there'll be more demand for plastic. So there's kind of a theoretical logic, but it's not really working out that way. In fact, there's a glut of plastic on the market in the same way there's a glut of oil and gas. And the financials for that industry also are very, very weak. So I don't believe the petrochemical or the plastic will be enough to rescue that business. We're doing a bit of a deep dive on a few of the petrochemical complexes. And there's one in the Ohio River Valley in Appalachia. And that has the advantage of very low feedstock, potentially. So ethane is what goes into this. So theoretically, if the input is low, wouldn't that help the economics? And what we did with our deep analysis is to look at the price that they can get from the plastic resins that they would sell. And they're down 30, 40, 50% from when the company was planning to produce this. And that particular example is Shell. But this happens with many petrochemical plants around the world, that the sad truth is that these investments cost $5, $10, $15 billion, and you're making a forecast that goes out 10, 20 years, and the world is changing. And so it's very challenging. And our view is the petrochemical industry will not rescue the fossil fuel industry.
Thank you. So we've just got a couple minutes left. I have one last question. I'd love it if both of you could answer this. Granted the arcana of finance, fiscal, and tax policy reviewed here, what should we who are concerned about the climate crisis and at work as climate advocates do about all this? I want to start with Lucas and then Kathy.
Yeah, I think about that a lot too. It's a good question. I think that our operating assumption has been that, you know, despite the sort of technical nature of these issues, that fundamentally there is a question of, you know, raw political power undergirding this stuff. And that it isn't really that these things are complicated and that's why we've been unable to move the needle on them. It's that the sort of climate movement, which has become, you know, more powerful and more unapologetic in recent years, hasn't quite reached the necessary critical mass to really start setting the agenda in terms of, you know, what is required to decarbonize our economy. I would say that, you know, broadly, what we need here is, you know, fundamental changes in tax policy. That's not just the, to reverse the sort of benefits that were passed through in the CARES Act, but we need to get rid of the 100-year giveaways to oil and gas. That remains really, really important. The Stockholm Institute has for years pointed to that as like one of the most crucial things that, you know, makes future extraction economical that wouldn't be otherwise. I think that, you know, at a certain point, what we need to start doing is we really need to start, you know, putting Wall Street on the agenda and to start, you know, making demands of these, massive monolithic financial institutions to make it more politically costly to them in terms of regulatory risk and, frankly, political risk to have them continuing to finance these operations. I think that we probably aren't going to convince the companies themselves, with a few exceptions. I'm not very optimistic about what is being put on the table right now by BP, but I think that there is a chance that some of these Wall Street targets are movable, and to do that, it seems like a cliche. What is needed is a climate movement that doesn't know how to that refuses to back down and is willing to put pressure on Congress, pressure on the status quo, and to accept that as we live through these unprecedented times, that what's actually required is to have some unprecedented solutions out there. And that's that word being overused again, Kathy. I'm sorry, but that's what comes to mind for me.
Kathy, do you have a thought about what we can all do right now, moving forward next month? Oh.
Forgive me. On an individual basis, I think to align your portfolios with your values, get a fossil-free portfolio. There are tools out there. So however you invest your money, we don't have collectively enough money, but it's important, in my view, to have a fossil fuel-free portfolio. And there are tools, As You Sow has something called
fossilfreefunds.org.
And I think it's important to look, if you are working at a company that offers a 401k, call your HR department and say, I really cannot have my money in fossil fuels. I think bonds have been overlooked. Someone here asked a question. Most people think it's just my equity investments, my stock investments. So I think there's a financial case that you're investing in the last place sector. So why are any companies, why are any financial institutions or any funds still invested in fossil fuels since their last place? And they've been last place for a decade. This is not brand new. And I think I would also encourage anybody looking into, this is beyond my area of expertise, is we need to have a price on carbon so that the incentives go the right way. As Lucas pointed out, right now the incentives are going the wrong way. They're supporting the fossil fuel industry, and they really need to put a price on carbon so we can get the incentives moving the other way.
Thank you. Thank you both. This is terrific. Just as great as I knew it was going to be. I'm really grateful for your time and for your hard work putting this really essential information together. And as I keep saying, we're going to send this video around, and I want everybody who's tuned in to share it widely, because this is what everyone, both the people in the movement that Lucas is exhorting and those of us who need to worry about our own investments, this is what we need to know. And so thank you all, and enjoy the rest of Climate Week. God, what projects, tuning into all of this. And do take a look at the 2 additional presentations that we've put together, one on coal tomorrow morning at 11 or 2, depending on which coast you're on, and another on legislation, which really keys into many of the things that we've talked about here today, at 4:30 Pacific and 7:30 Eastern tomorrow. So thanks a lot.